Hi, everybody. Welcome to Christensen Wealth Management. I'm Michael Christensen. Thanks for taking time out of your day to watch this stock market update and industry sector review for the week ending Friday, February 9th, 2018. Boy, it has been a week. Between last week's video and this week's video, it seems like the earth has shook and the skies have thundered. We have all kinds of volatility in the different investment markets, which will make for a much more exciting video this week. But before I get into the charts, let's begin with the quote of the week from Elizabeth Kubler-Ross. And if you don't know who Elizabeth Kubler-Ross is, she was a Swiss-American psychiatrist, a pioneer in near-death studies, and the author of the groundbreaking book on death and dying, written in 1969. She was born in 1926 and died in 2004. She once said, "People are like stained glass windows. They sparkle and shine when the sun is out, but when darkness sets in, their true beauty is revealed only if there is light from within." Wise words from Elizabeth Kubler-Ross. All right, let's take a look at that volatility that I was talking about. We'll begin with the Dow Jones Industrial Average. Here we have the 6-month chart of the Dow Jones Industrial Average, and boy, have things changed in the last week. We had a nice peak up here on January 26th, and then the dam broke, and boom, down we came, and we had, not in percentage terms, but in point terms, the Dow Jones Industrial Average fell more points, almost 1,200 points, in one day, which was the biggest point drop in U.S. history. It wasn't the biggest percentage drop. In fact, it was number 10 on the biggest percentage drops, but it was a big one. And you can see that the price fell substantially here, and the red 5-day moving average crossed rapidly through the blue 20-day moving average and is pursuing that 50-day moving average as well. So as of right now, we have short-term weakness, or I should say caution, on the Dow Jones Industrial Average. And you can see the blue 20-day moving average has formed a top and is converging on the 50-day moving average. So we've got intermediate term strength, technically, but rapidly diminishing strength. So caution is warranted on the Dow Jones Industrial Average. Here is the 6-month chart of the S&P 500, and pretty much the story is about the same, except the S&P 500 appears to be weaker than the Dow Jones. So we had a top here, same as the Dow, on January 26th, a sell-off, sideways move, and then boom, the floor fell out. And the 5-day moving average in red sliced right through that 20-day moving average in blue. And as of the 7th of February, that 5-day moving average went right through the 50-day moving average. And you can see the price of the S&P 500 in black is below the 5, the 20, and the 50-day moving average, which is not good at all. We have serious short-term weakness on the S&P 500. The 20-day moving average in blue has topped and is converging on the 50. We still technically have some strength on the S&P intermediate term, but it's rapidly diminishing because the 5 and the 20 and the 50 are converging. So not looking too hot for the S&P 500. And one of the things I look for is for a bounce with strength. Well, we came down and bottomed out here on February 5th. We tried to bounce on the 6th, and on February 7th, it just couldn't get there, and it had a down day. It was up quite a bit in the morning on the 7th, but gave it all away and closed in the red, closed with a down day on the 7th. So I highly recommend caution for the S&P 500 for the next 7 days. Here we have the 6-month chart of the NASDAQ 100, and you can see we topped out like the other ones on January 26th. Sold off hard here and bottomed on the 5th of February, bounced on the 6th of February. The first half of February 7th, we went higher but failed, ended the day down almost 1%, which is not a good sign for the NASDAQ 100. What we're looking for is a strong rebound. There was no volume on the Dow, S&P, or NASDAQ, meaning the buyers of stocks just didn't show up for the party. And so with no volume, all three indexes gave up their gains on February 7th. Well, the Dow did close, no, all three of them gave up their gains. They all closed in the red. So that means that February 8th and 9th will tell a lot. Unfortunately, this is being recorded after the close on February 7th. So I'll have to report in a future video or on social media how the next few days go. But right now we have short-term weakness with that 5-day average in red crossing below the 20-day, indicating caution on the kind of the hours to days time frame. But we still have that 20-day moving average in blue above the 50, indicating we still have some strength on an intermediate or longer time frame. But the red and the purple are definitely, not red and purple, blue and purple are definitely converging, indicating weakening strength on the intermediate term. So just a lot of caution on the NASDAQ and the S&P and the Dow, just so you know. Don't take this type of volatility casually. Here is the S&P 500 Information Technology Index for the last 6 months. We had a top here on January 26th, like all the others. And then starting on the 1st of February, the floor just fell out of it down to here. We had a bounce on the 6th of February. The 7th tried to go higher, didn't have enough buyers, did not have enough volume, and the price kind of collapsed on itself. And so we had a decline on the 7th, which, in my opinion, may not indicate a whole lot of sunshine for technology in the next week ahead. But we'll have to wait and see. As of right now, we have the 5-day average in red crossing below the 20, indicating weakness in the short term, and that 20-day has topped in blue there and is approaching the purple 50-day. So we've got weakness approaching, but not yet confirmed in the intermediate term. So we'll just have to wait and see. But caution in the short term on information technology. Here is the S&P 500 Consumer Staples Index for the last 6 months. And interestingly enough, as of right now, from the charts I've shown you, this one looks the worst. Boy, you would think that consumer staples would be pretty resilient because these are companies that make toilet paper and laundry detergents and Kleenex and things like that. But boy, we had a top here on January 26th, and as of right now, this one has been hit the hardest. We'll see what the other charts look like, but right now, boy, this one really fell out of bed. It's back to where it was November 14th, but it's not so much that as it is the severity of the decline. Look at that 5-day moving average in red. I mean, it went vertical straight down, cut through the 20-day moving average in blue, cut through the 50-day moving average in purple, and the price of this index is way down here. I mean, it's a long way from the 5, the 20, and the 50, and that 20-day moving average is rapidly approaching the 50, but I don't think I need to tell you much more than we have significant weakness in the short term and really rapidly approaching on the intermediate term for consumer staples. So caution is advised here on consumer staples. Here's the S&P 500 Industrials Stock Index for the last 6 months. We had a top here on the 26th. Similar sell-off to the other indexes, bottoming out on February 5th. Bounce, and then a small little bounce here on February 7th, probably on light volume. I haven't had a chance to look at that, but February 7th had very light buying activity on just about every index. But right now we've got a confirmed weakness in the short term with that red 5-day average crossing below the 20, and the 20-day average is converging on the 50, indicating decreasing strength or weakness approaching on the intermediate term for industrials. And here's the 6-month chart of the S&P 500 Utilities Stock Index. And this poor chart and this poor industry and index, this is definitely our ugly duckling. This poor thing is usually a pretty reliable industry. I mentioned a week ago that the 5-day average had crossed and everything looked like it was bottoming out. And man, on the 31st of January, this thing just continued to fall out of bed. On the 1st of February, then the 5th of February, and the 6th and the 7th, utilities are just getting beaten up more than I have seen an index getting beaten up in a long time. So there's no other way to say it other than we got short-term weakness all over the place, intermediate-term weakness, caution. I can't even stress the amount of caution going on with utilities. There is a serious problem in this industry right now. I mean, just look at that chart. So I'll leave it at that. Caution, caution, caution with utilities. Here is the 6-month chart of the consumer discretionary, or sometimes referred to as cyclicals, index, and this has been the all-star. That was the term I used in the last 2 weekly updates, and we had a pair. And in the previous updates, I did make it clear that parabolic moves in investments usually end with a rapid correction to the downside, and you can see that the rate of acceleration of this index was getting faster and faster and faster to the upside, and we were, as of right here on January 12th, we were starting to begin a vertical move almost, and then it kind of resumed its parabolic fashion. But we hit a top here on January 26th, and that's when the floor fell out of most of the U.S. markets. And we fell here, bottomed on February 5th, bounced on the 6th, tried to go higher in the morning on the 7th, but failed due to lack of buying in the sector, and the actual index closed down on February 7th, indicating significant weakness. And we do have confirmed short-term weakness with that red 5-day average crossing below the 20, but this one's still putting up a pretty good fight. We're a long way away from the 50-day average down here in purple. But that 20-day average appears to have topped, and it is starting to converge on the 50s. So we have decreasing strength in the intermediate term. So short-term weakness, caution on the intermediate term for discretionary. Here is the Dow Jones Financials Stock Index for the last 6 months. We had a top here on the 26th. A sell-off on the 29th and 30th, little bounce here, and then boom, the floor fell out of the entire market, taking financials with it. We bottomed out down here on January 5th, bounced, and pretty much had a sideways move on February 2nd. But we do have confirmed short-term weakness with the 5-day average in red crossing below the 20 in blue, and the price is below all 3 of them. That's not a good sign. The 5-day average in red is crossed below the 50, and that 20-day average in blue is topping and starting to converge on the 50. So really we have short-term weakness, decreasing strength in the intermediate term, or rather I should just say caution in all time frames for financials. Here's the 6-month chart of the S&P 500 Energy Stock Index. We had a top up here on January 22nd, a few days of kind of sideways movement, and then sell off, a bounce, and then the floor fell out of it, and So many of the same comments as the other indexes. We got short-term weakness, red crossing blue, or 5-day average crossing the 20. And then the price is way down here, so there's nothing great about energy right now. It's below the 5-day average in red, below the 50, below the blue, which is the 20. So in all time frames, we have either short-term weakness and intermediate term caution due to the fact that the 20-day average has topped and is approaching the 50. So caution on the energy stock index. Here is the 6-month chart of the S&P 500 healthcare stock index. And this poor index sure got beaten over the head. A few weeks ago, it looked like a really nice success story. Starting on December 29th, right here, it just skyrocketed and peaked on January 26th. And I can't really describe it except that this thing just got just absolutely destroyed. I mean, look at that thing. It just fell all the way back to where it was here in half the amount of time. That poor index did not get any love whatsoever, and it tried to bounce, but it's really struggling. We got a short-term weakness confirmation here on February 2nd, and the price is way down here. So we've got intermediate term caution, confirmed short-term weakness, nothing positive about this healthcare index chart. It's just extremely weak as of right now. And here's the Dow Jones real estate stock index for the last 6 months. It pretty much had a top here on November 13th, and real estate has been just going down the same as utilities. No love for real estate. In fact, the decline is accelerating, meaning the rate of the decline is accelerating faster and faster. We're getting steeper and steeper to the downside. And similar to the other indexes, we had a little bounce here on January 31st, and then the floor fell out of real estate. And on February 7th, the decline continued. Everything about real estate on this chart is weakness and caution and avoidance. There's nothing positive about this chart at all. So you got the 5-day average almost pointing straight down, continuing to pull away from the 20. So lots of weakness there. And the 20 is pulling away from the 50. So that we got a lot of weakness on the intermediate term as well. So caution in the real estate index as of right now. Thanks again for taking time to watch this video. I hope you found the charts and the information useful. But before you go, please take a moment to click the subscribe button on this YouTube channel and click the little bell next to the subscribe icon so that when I post additional videos, you will be notified immediately. And also, go ahead and go to your favorite social media sites. Go to Facebook, LinkedIn, or Twitter, and look up Christensen Wealth Management and like or follow those pages as well. I learned a few days ago that when the stock market starts to get very crazy and I want to share information with you quickly, a YouTube video is not always the best option. It takes several days to record a video, get it approved, upload it, and share it. But using Facebook, LinkedIn, or Twitter, I can share some thoughts with you, share some charts with you immediately when they need to be shared. So using all these different tools together is a very useful combination. But before I go, I just want to remind you, use caution in turbulent times like these. It may go higher, but if it doesn't and the stock market goes lower, you may save yourselves days, weeks, months, or years if it goes lower, just trying to get back to even. A wise individual once said to me, getting back to even is not an investment strategy. And those are some very wise words. So have a great day, and I look forward to talking to you soon. Bye-bye.